Very excited to be here with you all today and talk more about impact first investing, which we very much feel at Bridgespan is the next frontier for impact investing. So I'll give a brief overview of what impact first investing is, but do want to just take a step back to actually define impact investing as a starting point. So impact investing is investments that are made into companies or organizations with the explicit intention to generate social or environmental impact alongside financial returns. And actually, the origins of impact investing, which has been around for a while now, really were in what we call impact first impact investing. And that's one of the reasons why impact investing is called impact investing. It is because of that emphasis on impact. I'd say over the past 5 to 10 years, there has been a real interest from institutional investors, primarily private equity, on finance first impact investing or market rate impact investing, where these investors have been very much focused on proving out that you can both have impact and generate competitive financial returns. And so we've seen a lot of activity and action in impact investing that has fallen into that finance first or market rate impact investing space. And we think that's fantastic. And it's really gotten a lot of action in impact investing. It's really raised the profile of impact investing in the US and around the world. Oh, and Everett could just go on mute. Great. We feel at Bridgespan, and the report that we just released demonstrates this, that there really is an opportunity to focus on impact first impact investing at this time. And what we mean by this is a type of investing in which impact is first. That is the primary goal, social and environmental impact. And it does sit on this financial return spectrum in between market rate impact investing and philanthropy. And what that means is that there is no expectation with this type of investing that you will generate market rate returns. That doesn't mean it can't happen, and it does happen, but that's not the explicit goal, and that's not why the investment is made. This is also different than philanthropy, where you make a grant and there is no expectation of any financial return. It's a 100% loss of capital with philanthropy. So it's different from that because there is an expectation with impact first investing that you do get some of your capital back. You could get partial capital recovery, or you could generate some modest returns. But most importantly, the reason you are making this investment is because you believe there is important impact, and without your investment, that impact would not happen in the world. In terms of impact first investing, it's very much well suited for individuals and investors that are willing to take on higher risk. And as a result of this willingness to take on higher risk, they are able to invest in entrepreneurs or businesses or organizations that are often early stage or otherwise risky. And in general, these types of enterprises really struggle to raise capital. The implication is that actually without this type of investment, these organizations and companies and entrepreneurs may never actually get the funding they need to prove out their concept. And so what we really emphasize with impact first investing is it's that but for capital. But for this investment, this impact would not happen in the world. And the quote that's in green is from MacArthur, and they have started the Catalytic Capital Consortium. It's a really fantastic resource, especially for foundations that are interested in catalytic capital. Catalytic capital and impact first investing are the same thing. We're just using a term that it does seem the field is starting to move more towards, which is impact first. And we found that impact first investing is an unbelievably powerful tool to address some of the biggest challenges happening today. So we've listed a few on this slide: climate change, racial equity and justice, economic mobility, food and agriculture, especially outside of the US. But these are just a few of the issues that can be addressed through impact first investing. Really, the power of impact first investing is that it's a tool that investors can use alongside other tools as a part of a portfolio. So we have many examples of funds that are just developed around impact first investing. There are also examples of funds as well as foundations that say, we're willing to use all sorts of capital tools. We're willing to use grants. We're willing to use impact first investing. We're willing to use market rate investing in pursuit of achieving impact. Just to give an example here, in terms of the racial injustice space, so first off, in the report, and I'll get to this in a little bit in the presentation, there are 3 main steps to getting started with impact first investing, and that's how this slide is structured. So as I talk through it, we will get back to these 3 points, but just wanted to draw that connection. But first and most importantly, when thinking about doing impact first investing, we found that it's really important to clarify your values. And in particular, equity can be an anchoring value or an anchoring social issue that you decide to take on. Spring Point Partners, which is a Philadelphia-based family office, actually has a full fund that's designed around impact first, and they've aligned their entire investment portfolio to focus on diversity, equity, and inclusion. Another important step in making impact first investments is to seek advice from others, to find ways to connect with those that you hope your investments will help in the end, to learn from others who are close or proximate to the populations that you care about. And Kenny Earth has done a great job at this, and that's another family office. And they have made a number of investments in community development financial institutions to help small businesses during COVID-19. And they did that in partnership with others. Another step in terms of making an impact first investment is to know that there are a lot of investment options out there. In terms of racial injustice, we at Bridgespan have done a scan, and we found that there are over 170 market and below market rate investment funds that are either focused on economic mobility or racial equity. So all to say that if you decide to do impact first investing, there is often a misperception that there just aren't opportunities out there. And what we found a number of opportunities alongside each of those social issues that I highlighted. So in particular, our report focuses very much on encouraging high net worth individuals and family offices to really step up and take the lead on impact first investing. A few reasons for this. One is that high net worth individuals and family offices have the resources to lead. So the wealth of these families has doubled over the past 15 years. When you look at ultra high net worth individuals, which we're defining as those that have investable assets of 30 million plus, their total assets went from 17 trillion to 36 trillion. When you broaden that to high net worth individuals that have at least $1 million in investable assets, that goes up to 104 trillion. So that's close to half of global financial assets. So when you think of these massive social challenges that are happening in the world today, high net worth individuals have to play a critical role in bringing capital to solve those problems. In particular, we also feel like impact first investing is very much an underutilized tool for this group. A few reasons for that. So one is the focus on impact. There is a real interest in sustainable investing that we found within high net worth individuals and family offices. We also know we are about to experience, or we are experiencing, the largest transfer of intergenerational wealth, and that money is going to next gen and millennials. And there are many, many studies that show that millennials and next gen are very focused on impact. They're really changing the way that investing is done today. Second is that these families often have increased flexibility. They are not bound by the same fiduciary obligations as institutional investors, and as a result, they can innovate and experiment with their wealth and put impact first above financial returns. Third is that we found that there is a real meaningful gap between aspiration and execution in terms of impact. So while family offices believe that they have a meaningful role to play in tackling global challenges, today impact investing is just a small part of their portfolios. And we do think a big part of that is because impact is not always front and center in impact investing conversations. So if we can help folks realize the opportunities that exist with impact first investing, that can help get some of that capital off of the sidelines. And finally, there's a real ability to lead the field here. So we, in our report, shined a light on a number of family offices, as well as other types of investors that are doing impact first investing, and yet it's not enough. There's really an opportunity to expand those that are leading here and to pave the way for much more impact first investing. A couple of examples, and I know I talked about Kenny Arth a little while ago, but Kenny Arth is a UK-based family investment office, and they actually decided to align 100% of their assets to impact. And so they've done some really innovative work with impact first investing. I highlighted their the more recent work they did with CDFIs, but all to say that if you're looking for inspiration for those that have really committed to impact first investing, Kenny Arth is a great place to start. Another approach is Breakthrough Energy, which is completely focused on climate change. And they are really, they were really created in recognition that philanthropy alone, nor the private sector could solve the energy crisis in isolation. So their idea is to really run the full returns continuum and do impact first investing to help invest in some of those early ventures that could solve the climate crisis. There are some additional examples at the bottom, but again, these very much are the pioneers that we found in impact first investing. A question that we're often asked is, what actually is an impact first investment? What does that actually mean? So we've put a couple of examples here on this slide. I'll just talk through one with D-Light. But essentially, the social challenge or the need that D-Light is solving is access to electricity, but more importantly, access to safe electricity. There is a significant use, especially in India and Africa, of families that rely on kerosene for lighting, which is both toxic and expensive. So the idea with D-Light is that these are solar lanterns and home solar systems that can provide clean, safe, and affordable energy. And in order for D-Light to get off the ground, it really did take impact first investments. That includes Acumen, Gray Matters Capital, but not for those initial investments where they were willing to take on lower rates of return, higher risk. A company like D-Light might have never thrived. So a few other examples on this slide, but all to say, hopefully these can help bring to life the types of businesses that thrive as a result of this type of investment. In terms of how to make these investments, and I'll get into that on the next slide as well, but there are a number of impact first funds that also exist. So again, to the point of, okay, I buy in, impact first investing is important. I'm interested in starting to do this. Where can I look to actually make investments? There are funds out there that exist where this is the focus. And some of them are targeted on specific issues like water equity, for example, that's focused on global water and climate crisis. And others are broader and are either focused on different places or different populations and people. So these are the three steps that I mentioned earlier in terms of how to get started. And this is laid out in detail in the report, so I'll just talk through a few of the highlights. But first is clarifying your commitment to impact. And what we found is that impact first investing is really most successful when families or individuals or even foundations think about what are the issues that they care most about, and then figuring out what are the tools that they can use to help address those issues. And that's where we feel like impact first investing can be a really compelling part of a fund. Second is, who can you talk to about this? There's no need to start from scratch. There are folks out there doing this. There are funds that exist. There are advisors. And we know that in particular, high net worth individuals really appreciate using their networks and learning from others. So we really encourage collaboration in this space, and to say that there is no need to do this alone, no need to start from scratch. And third is choosing the investment approach that best fits your needs. There are options here. There is the option to fully outsource and to work with an advisor that can help direct funds to a number of different places. There are also some families and teams that have actually decided to hire people in-house focused on impact first investing. So that can either look like a lean team where there are 3 to 4 people, for example, that are hired to explicitly focus on impact first investing, or it can be a larger team. So for example, like Spring Point Partners, where there's an entire staff that's dedicated to an impact first fund. So all to say, there are a number of different options for getting started with how to actually do impact first investing. Some of the questions to consider at the bottom can also be helpful to help you figure out for each of these, where do you fall and who can you learn from along the way. So those were the highlights from the report. I'm happy to take questions now and do encourage you to read through it and let us know if you have questions after the report, as there is much more detail in there.